That's like, I've seen 3 people. That's like
While we're waiting for the last minute or so, by last count, I've returned about 410 DCFs. I think in the 2 classes put together, there are about 500 something people. So about 90 of you who still have DCFs waiting out there. I know the window stayed open a really long time. It's like 10 days past now, but I'll leave it open for the rest of this week if you still want it. But it's, by some point in time this week, I've got to put an end because otherwise it keeps dragging in. And for those of you who are on your 4th revise and resubmit, just stop, guys. Come on. You have enough feedback from me. If you know what to do. So I think more affirmation than feedback you're looking for. So. Okay, so let's start with today. We're going to actually, what I'm going to say, this is going to sound like an overstatement. We're going to crack the code behind pricing. You know what I mean by cracking the code? If somebody from this day on says, why is this stock trading at 50 times earnings? I'm going to give you the code to tell you why some companies trade at high multiples, others. It's going to be very simple. At the end of this process, you're going to say, I should have thought of that myself. So let's start with today's test because we're going to lay the foundations for asking the right questions. And that's what today is going to be about, asking the right questions. So 3 companies. I'm being very creative. I'm going to call them Company A, Company B, and Company C. They have the same cost of equity, 10%. Company A has a return equity of 12%, Company B has a return equity of 10%, and Company C has a return equity of 8%. Same business, same cost of equity. One of these 3 companies is likely to trade at less than book value. Which one is it? Which of these 3 companies is likely to trade at less than book value and why? I heard a C back there. What is it about C that makes it trade at less than book value? Or did I hear a C and I made up a no? I thought somebody said C from around here. Okay. And why do you think it'll trade less than book value? If you earn a return equity consistently that's less than your cost of equity, guess what people have to do? They have to attach a market price to your company that's lower than your book value. Already you can cast as a lie this rule of thumb. If something trades at less than book value, it must be cheap. It's amazing how widely held that is. That is not true. Let's carry this forward. Let's say company C made a terrible investment 5 years ago. You know what accountants are allowed to do with terrible investments? It writes it off. And when it writes off this terrible investment, its book value of equity drops by 50%. If your book value of equity drops, what happens to your return on equity? It's going to go up because you have a lower base. What happens to your price to book? It's also going to double. So one of the nice things about connecting price to book and return equity, whatever happens to one is also going to play out in the other. Okay? With price to book, return on equity becomes what I call the companion variable. Filed it away, it's kind of a concocted number. The companion variable basically means if I give you only one question, I allow you to ask. So let's say I'm a broker, I call you and say, hey, do I have a stock for you trading at half of book value? The only question you're allowed, you know what you should reserve that question for. What's the return equity? 9 times out of 10, that's going to crack the code. And why is the stock trading at half of book value? Let's try a different example. In retailing, one of the multiples that people use is the revenue multiple. And last session, we talked about consistency in that multiple. Many analysts use price to sales, but we said that's not consistent. So I'm going to use the more consistent version, EV to sales. EV, of course, is equity plus debt minus cash divided by it. So let's say you compute this for all retailing companies, and then you put them into 3 buckets: department stores, discount retailers, and luxury retailers. If you're picking companies based just on EV to sales, and you pick companies with low EV to sales ratios, which of these 3 groups of companies is most likely to look cheap to you because they trade at low EV to sales?
Discount retailers, because their margins are
Exactly. He's got the companion. You guys already know what's coming today because that is basically what you're doing in pricing is you're saying, look, just because a stock trades at a low PE ratio doesn't make it cheap. Just because a stock trades at a low price to book ratio doesn't make it cheap. You're looking for mismatches. You know what I mean by mismatch? You want a stock with a low price to book and a high return on equity. You want a company with a low EV to sales and a high margin. And today we're going to expand on that notion of mismatches. And I'm going to give you a way in which you can make that mismatch even more complete. So let's put the test away and turn back to where we were. So we were talking about descriptive, Moneyball with pricing. Remember, we looked at descriptive, and it's not rocket science. We just put histograms, and I said that, when you look at PE ratios or price to book or EV to sales, don't expect that distribution to ever be normally distributed. It's not a symmetric distribution. And we looked at how it's similar across markets. So the last thing I want to say about doing this descriptive test is it becomes a great way to push back against rules of thumb. I mentioned one already: stock that trades at less than book value is cheap. You know how many US stocks traded at less than book value at the start of 2022? 1,500 companies traded at less than book value. There are 7,200 companies in the sample. 1 in 5 companies trades at less than book value. That's a very strange definition of cheap. You hear people say that a stock that trades at an EV to EBITDA less than 8 is cheap. You count the number of companies that trade less than 8. It's a great way of pushing back when people say this is cheap. Just count the number of companies. How can this be cheap? So let's take that EV to EBITDA. I remember being on an LBO panel. This was about 15 years ago when LBOs were big. And with all these big LBO players. And one of the LBO players said, "Why are you wasting your time on valuation?" I said, "Okay, what do you do?" He said, "We know what cheap is. Less than 6 times EBITDA is cheap." It's interesting. It's amazing. 6 times EBITDA and below is cheap. Anything above it. Is 6 times EBITDA cheap? I'll tell you when it was not cheap. In 2010, if I drew a histogram of EV to EBITDAs, half of all US companies, let me repeat that, half of all US companies traded at less than 6 times EBITDA. How the heck can that be cheap? In 2022, maybe 6 times EBITDA works as long as you're not in Russia or Japan, because their 6 times EBITDA would put you closer to the median. Do you see where I'm going? 6 times EBITDA can't be cheap for all markets and all times because the number obviously shifts. You say, what choice do I have? If I asked you to define cheap, rather than give me an absolute number, is there a way you can use this distribution to tell me what's cheap? Why not just say the 25th percentile is cheap? That number obviously will be different for different geographies, different for different times, but it's a much more sensible way of defining cheap than to put an absolute number. I don't like absolute rules of thumb precisely because they might have worked at the time they were created, but who knows when they were created? 1978, we're still sticking with these rules of thumb, even though they don't work anymore. So when we do descriptional tests, it gives us the ammunition to push back. Because without it, you're sitting there, I don't know, this guy's been in the market 40 years. He must know, or she must know. This gives you a way of pushing back with the data, saying that makes no sense. Let your inner Jonah Hill out. Play Moneyball with these. Think of them as the equivalent of the old scouts in that movie. You have a lot of investment people who essentially have these rules of thumb and stick with them even though they've stopped working. So now we're going to talk about what it is that drives multiples. You look at a multiple, PE ratio, EV to EBITDA, EV to sales, whatever the multiple is. There are 2 questions you need to answer before you start using that multiple. First, you need to tell me what the variables are, the fundamentals are that drive that multiple. I'm going to give you a very easy trick to come up with those variables, but I'll give you a preview. When you look at the PE ratio of a company, the PE ratio for a company is driven by 3 fundamentals. Its payout ratio, its cost of equity, and its growth rate. Saying, how do you know so precisely? I'll give you a very simple way of extracting those 3. Those are the 3 variables. But that's just the first step. If you told me higher growth companies have higher PE ratios, that's nice, but that doesn't help me very much, right? Because how much higher? If your growth rate is twice as high as mine, is your PE ratio twice as high? So the second question you need to answer is, how, as those fundamentals change, will your PE ratio change? So I need to come up with a device that can answer both questions. And here's the device I'm going to use. Remember, by now we've done DCF already. We put it to rest saying we're done with DCF, but I'm going to go back to my DCF roots and I'm going to use them to figure out what the variables are that drive a multiple. To see what I'm going to do, think about the two types of multiples you have. You have equity multiples like PE ratio and price to book, and enterprise value multiples, EV to EBITDA, EV to sales, EV to invested capital. Here's the trick. If you have an equity multiple, start with the simplest equity valuation model you can think of. The simplest one I can think of is a stable growth dividend discount model. Why simple? The algebra gets much simpler. We'll talk about what to do if you want to make these models more complicated. So start with a simple equity valuation model. If I have the stable growth dividend discount model, and I do a little algebra, I can restate that model in terms of PE ratios or price to book, and I'll show you how it works with PE. But I can take any equity multiple and state it in terms of a dividend discount model and say, in the dividend discount model, this is what a PE ratio should look like. This is what a price to book should look like. Every equity multiple, go back to an equity valuation model. If you have an enterprise value multiple, go to the simplest enterprise value model you can think of, which is just a stable growth free cash flow of the firm model. I've just written the expanded version of free cash flow of the firm. After tax operating income times 1 minus the reinvestment rate. And because it's stable growth, it's divided by cost of capital minus the growth rate. Again, with a little bit of algebra, I can take that equation and make it an equation for EV to sales or EV to EBITDA or EV to invested capital. It's an incredibly powerful tool because if you can use it, you can tell me what the variables are that drive any multiple. So I'm going to take a series of 6 multiples and take them through the process. I'll tell you upfront that by the time you get to the 5th multiple, you're going to say, you're doing the same thing over and over again. And I am, because I want to make this almost second nature for you. Because when I come up with a new multiple, it's your job to take it through this process and say, these are the questions I need to be asking about. So let's start with the most widely used multiple in the world, PE ratios, and let's see what drives that multiple. Stable growth dividend discount model, right? Value of the stock is expected dividend next year divided by cost of equity minus the growth rate. It's as simple as you can make an equity valuation model. That's an equation. If I divide both sides of an equation by a constant, it stays an equation. Everybody agree with that? Basic algebra. Let's say I divide both sides of an equation by earnings per share. If I divide price by earnings per share, I end up with PE ratio. If I divide dividends per share by earnings per share, what do I get? I get a payout ratio. And because I need expected dividends next year, I'm doing a 1 plus G. If you don't want to do with the 1 plus G, just dispense with the 1 plus G because it just takes this year's earnings and makes it next year. So that's in the numerator. Denominator is cost of equity minus growth. Let me pause right there. For a stable growth dividend paying firm, the PE ratio is a function of 3 variables. Its payout ratio, its cost of equity, and its expected growth rate. Now, one of the reasons we're a little reluctant to use dividend discount models is because companies don't always pay out what they can afford to. And remember what we substituted then? If you don't trust what companies pay out, you can compute what they could have paid out. The free cash flow equity is potential dividends. So you can even state the PE ratio in terms of potential dividends. If you have a company that could pay a dividend that chooses not to, but it's a mature company, its PE ratio is a function of the potential dividend payout ratio using free cash flow equity, its cost of equity, and its growth rate. That's true. This is a model designed for a mature company. Now, most of the time when you're thinking about, is this company trading reasonable PE ratio, you think about high growth companies. It could be an NVIDIA. NVIDIA is a high growth company saying, what's a reasonable PE ratio for a high growth company? I'm going to show you a page that at first sight is going to look intimidating, but it's actually much simpler than it looks. So now what I'm going to do is go from a mature company to a high growth company. I'm going to still stick with the dividend discount model. Now, if you had a spreadsheet and you had to do a dividend discount model for a high growth company, you know what we do, right? We project out the dividends during the high growth period. And at the end of the high growth period, what do? We compute a terminal value and we discount it all back to the present. I'm going to take what we do in a spreadsheet and write it as a mathematical equation. This is not my first instinct, but it compresses the whole form. So this equation that looks incredibly intimidating, the first part of the equation is just the present value of the dividends during the high growth period. It's actually a growing annuity formula. So basically, I've taken the dividends for the next 10 years. The second term in the equation is just the terminal value discounted back to today. So essentially, it's what we do in an Excel spreadsheet written as one equation. You're saying, why bother? If I divide both sides of that equation by earnings per share, I end up with the variables that determine a PE ratio for a high growth firm. Let me remind you again, for a mature firm, it was payout, cost of equity, and growth that determined the PE ratio. You know what variables determine the PE ratio for a high growth firm? Payout ratio, cost of equity, and growth rate. The only difference is you estimate them twice, once for the high growth period, once for the stable growth period. You make this a 5-stage model, same 3 variables estimate. This is incredibly good for us because it basically means from this point on, you're not going to see too many 2-stage models, because once you've done this, the boring mature model, you got the variables nailed down. And you can then use those variables to answer pretty much every company, every question you run into with that multiple. So let's take that equation for the PE ratio. And notice it looks very messy, right? It's got payout ratio, cost of equity, and growth rate, but it's really the 2-stage model. By itself, you might say, what difference does it make? Now, one of the questions I said you'd like to know is, as PE ratio, as growth changes, how will the PE ratio change, right? Do you guys remember high school calculus? You probably had to take calculus at NYU too, right? If I asked you, this were a math class, and I don't want to deal with real companies, I gave you this equation and said, how will the PE ratio change as the growth changes? This were a calculus class, what I'm asking you to do. Take the first differential of that equation to growth, and you will get it. I'm not suggesting you need to do it, so don't freak out. But if there's for a math class, you can answer that, right? It's a that's one of the advantages of taking an Excel spreadsheet and writing it as a mathematical equation, is you can actually answer that question. But I'm going to take the low-tech approach. Here's what I'm going to do. I'm going to create a hypothetical company. And I'm going to come up with the intrinsic PE. And I'm going to explain what I mean when I say intrinsic PE for this company. So here's what this company looks like. It's a high growth company. For the next 5 years, it expects to grow at 15% a year while paying out 25% of its earnings as dividends. After the 5th year, the growth rate drops to 1.5% and it expects to pay out 92.5% of its earnings as dividends. Why? Low growth, much higher payout ratio. For simplicity, let's assume the beta is 1 in both periods. If I asked you to compute the intrinsic PE ratio for the company, which basically means you're using a discounted cash flow model to come up with the PE ratio, here's what you would do. First step, you'd compute a cost of equity. With a risk-free rate of 1.5% and an equity risk premium of 5%, the cost of equity you'd have is 6.5%. I have everything I need to plug into the equation. There's the payout ratio in the high growth period, growth rate in the high growth period, cost of equity in the high growth period. So that's the present value of the dividends during the next 5 years. At the end of the 5th year, there's my payout ratio and stable growth, terminal value discounted back today. If this company traded at its intrinsic value based on a dividend discount model, it would trade at 29.15 times earnings. I want to emphasize here that if all you do is plug numbers in the equation, you're just using a 2-stage dividend discount model to value the company. That's not the point of doing it. It's to understand what drives the PE ratio. So what I'd like to do is take this hypothetical company and ask some questions. Let's say you bought the stock. 29.15 times earnings is a pretty high PE ratio, right? What is it about this company that you find attractive? Why are you paying 29? What part of this company makes it trade at a high PE ratio?
The growth.
It's high growth rate, right? So let's say you buy 29. You take my advice. You pay 29. What's your nightmare scenario after buying a growth stock? That you wake up tomorrow and growth has gone away. Right? We think of all those people about Peloton a year ago, woke up and, oh my God, there's no growth. Let me ask you the easy question first. If tomorrow you wake up and growth is lower than the 15% that you thought, what's going to happen to the PE ratio? It's going to go down, right? But I can be explicit here. It's a hypothetical example, but I change the growth rate from 0 to 30%. So instead of 15%, it could be lower than expected or higher than expected. I'll give you the kind of slam dunk easy findings. As the growth rate goes up, what happens to the PE ratio? It always goes up. Notice even at 0% growth, the stock trades at 20 times earnings, right? Because it still has earnings, it's a perpetuity. But as growth goes up, the PE ratio goes up. You're saying, why are there 5 columns? I looked at 5 different scenarios for the risk-free rate, ranging from risk-free rates of 0%, that would be Europe, right? The EU risk-free rate is 0%, to risk-free rates of 6%. At every risk-free rate, it's true, as growth goes up, the PE ratio goes up. But here's where it gets interesting. So let's assume this is the entire market. You have companies with 0% growth rate, 3% growth rate, 6% growth rate out there. We're in an environment now where everybody's talking about interest rates going up. One of the big questions is, who's going to be hurt more by interest rates going up? Is it high growth companies or low growth companies? Is it tech companies or food processing companies? I tried to answer the question by looking at the percentage change in the PE ratio for each group. If you're a very low growth company, you're still affected by interest rates going up, but you're affected less than high growth companies. Intuitively, why is that? Why are high growth companies affected more by interest rates going up?
Because more of their cash flows are farther in the future.
The further your value comes from growth in the future, the more you're going to be hurt. And in fact, if I make this a young money losing company, as many of you are valuing, with all of your value coming from that big terminal value, you're going to be even more exposed to interest rates going up. I mean, remember, when you started this class, the T-bond rate was 1.5%. Right now, the T-bond rate is 2.5%. Even in the 2 months you've been looking at your company, its value has shifted. It's a high growth company, it's shifted even more. So as interest rates rise, you're going to see PE ratios drop across the board, but more so for high growth companies than for mature companies. Any questions on that table? So as you watch CNBC for the next few months, you're going to see this play out. Our experts are going to come in and say this sector, but step back, because in a sense, it's basic math, it's present value that drives this dynamic. The second question I asked was, if I looked at different growth rates and I varied the beta, remember in my base example, the beta was 1. I said, what if we're low risk versus high risk? Let me again start with the easy dynamic. For any given growth rate, as I go from low risk to high risk, take a look at what happens to PE ratio. It always goes down. Riskier companies will always have lower PE ratios for any given growth rate because the risk contaminates the value of growth. But if you think about what this tells companies, remember, if you're a high growth, high risk company, there are 2 ways you can try to pump up your PE ratio. One is you can go for even higher growth. The other is you can actually try to reduce risk. I think too many high growth companies get so focused on growth and growth and more growth that sometimes they forget that the best way to increase your PE ratio is to actually start to scale down your risk. When we talked about Amazon in January 2000 and Amazon in 2001, from the dot-com boom to the bust. Of course, it was affected. But I think the dot-com bust actually made Amazon a more powerful firm, a better firm, because all of its competition got wiped out. And you think about what is it that allowed Amazon to escape from that? In 2001, and this is where you got to give Jeff Bezos credit, when the market was going into this tailspin, he brought down all of his growth ambitions. He said, no, right now, don't even think about growth. We're going to focus on survival and safety, because we can always go back to growth. And it was the perfect decision to make. And sometimes companies choose not to make it because they get so fixated on growth. One final table that I did, and this is a nice thing about having an equation and a hypothetical example, is I can hold everything else constant. I looked at 2 things on a company. And and there's one more thing I wanted to say on the previous page. I'm sorry. There are some, when you think about a perfect company in terms of characteristics, you want a company with high growth, right? And you also want a company with low risk. There are very few companies that can manage to combine the 2, low growth and high risk. And when you get that combination, guess what you get? You get what I call the superstars, the FANGAM stocks. It's high growth and low risk. At the other extreme, there are companies that I call investment dogs. They get the worst possible combination. They get low growth and high risk. Airlines. There's no high growth. Many of you valued airlines. What's the best you're going to hope for? Even if you take a company like Southwest, which is a healthy airline, you're not going to get 15% growth. The market is mature. So you're going to get low growth and lots of risk. So one way to think about companies out there is in terms of these dimensions. What's the combination of growth and risk I'm getting in this company? Because that's going to determine whether I trade 50 times earnings or 10 times earnings. Last, what if I looked at the growth rate? And remember what we said when we did DCF valuation. He said, not all growth is created equal, right? Growth can increase value, decrease value, or do nothing for value. And what is it that drives it? What kind of return on equity or return on capital you make on your investments? Here, because I'm looking at PE ratios, I'm staying with return on equity. Again, let me start with the easy part. For any given growth rate, the higher the return on equity for a company, the higher its PE ratio. Why? Because it's able to deliver the same growth with a lot less reinvestment. So when you look at growth, you probably also want to bring in the return equity, because if you have a company with a return equity that's less than its cost of equity, you know what's going to happen? As I grow, the company's PE ratio actually gets lower. It's one of those strange anomalies. Yeah, growth is good, but not when you're earning less than the cost of equity. So you ready? I want you to construct the perfect cheap company to buy on a PE ratio basis. I'll start you off. You want a low PE ratio, it's cheap, right? Do you want low growth or high growth? You want the perfect cheap company. You don't want low growth because so you want high growth. You see where I'm going, right? Low PE, high growth. You want low risk or high risk? You want low risk. So basically you want nothing that explains away the low PE. You want low PE, you want high growth, you want low risk. You want a low return on equity or a high return on equity? You want a high return on equity. Remember I gave you access to S&P Capital IQ. Some of you might have used it. One of the great things about S&P Capital IQ is you can run these screens. So you can say, find me all stocks that traded less than 10 times earnings. For God's sakes, don't just buy all those companies, because you get a lot of garbage in there. You can then put in a screen, find me all companies. So you find the companies trading at less than 10 times earnings. Find me all companies with expected growth rates greater than 10%. They actually have analyst estimates of growth and earnings for a company. You'd start with, so I think you'll find 1,200 companies trading at less than 10 times PE. When you put in that 10% or higher growth rate in earnings, that'll drop down to 100 companies, basically because there are far fewer companies that can have both low PE and high growth. Don't stop there. Come up with your proxy for risk. You can use beta if you feel that's your best proxy for risk. You can even say, look, I think big companies are safe and small companies are risky. You can use market cap screens. I want companies with market caps that exceed 5 billion. The 120 companies will become 20 companies. Don't view this as a bad thing. This is good that you're narrowing your scope. And finally, put in a return on equity screen. I want only companies that have returns on equity greater than 20%. You might end up with only 3 companies. But those are companies that now have passed through all 4 screens. Again, you're not going to jump in and buy those companies automatically. Maybe something terrible has happened in the news in the last week. But that's the advantage of screening, is it takes 7,200 companies and narrows your focus. You can now do a discounted cash flow valuation on those 3 companies if that is your preference. But that's why I think screening is still a useful tool to have in your arsenal, even if you're a true believer in intrinsic valuation. So I want you to take the lessons we have about P ratios, because I'm now going to play the role of really naive analyst, and I'm going to give you some really bad advice. And I want you to not just reject the advice, but tell me what's wrong with my advice. So it's January 1st, 2022. Here's what I did. I went and computed the PE ratios for 9 different markets, 10 different markets. And then I come to you and I say, you know what, you should take all your money. This is pre-Ukraine. So I'm not even using the benefit of hindsight. I say, you know what, you should take all your money and buy Russian stocks and Pakistani stocks. They have the lowest PE ratio. What am I missing? This is the easy one. When I just pick, go ahead.
Very low growth rate.
Growth is not, it could be, but I think more important than growth, when you think about Russia and Pakistan, it's risk, right? It's always good to ask about growth. Maybe that could be the reason. Maybe Russia has lower growth, but it's risk. Country risk is huge. It's actually, if you think about what's happened to those 2 countries in 2022, the market is actually being very, very, very proactive in terms of Russia and Pakistan. So be careful. Don't put your money in a country with the lowest PE ratios because you might be getting the riskiest, worst market in the world rather than the cheapest market. Take a second example. And here I'm going to take country risk and carry it forward because the problem with comparing PE ratios across countries is already you can say, but risk could be different, growth can be different, interest rates can be different. So this is from 2000, long time ago. Think of this as an old example. So there are a bunch of emerging markets. I've got the PE ratios for these markets. But in addition, I also collected data on 3 other variables. The first is interest rates in each of these countries. The second is real GDP growth. And the third is country risk. So the higher the country risk number, the riskier the country. With each one, tell me the dynamics of how as that number changes, the PE ratio will change. Let's take interest rates. Higher interest rates should lead to lower PE ratios or higher PE ratios? Should be lower, holding all else constant. Higher real growth in the economy, good or bad? Good, so PE ratio should be higher for higher real growth. And higher country risk, good or bad? Bad. So basically, you should expect PE ratios to be lower. So basically, you should expect PE ratios to be lower as interest rates go up, higher as economic growth goes up, and lower as country risk goes up. You see the problem with on the one hand, on the other hand analysis? For instance, Turkey looks really cheap. Oh, by the way, it's also very risky, and its growth looks bad. This is where I think that the point I made about pricing being statistics comes into play. Remember multiple regressions in statistics? Act like you do, even if you've completely forgotten. In a multiple regression, you have a dependent variable and independent variables, right? What are you trying to do? You're trying to explain changes in the dependent variable using independent variables. Bring it into play here. What are you trying to explain? Differences in PE ratios, right? And what are the 3 things that worry you? Differences in interest rates, differences in real growth, and differences in country risk. So I opened up to my multiple regression chapter in statistics, and I ran a multiple regression. One of the nice things about living in the age that you do is none of us has to know how to run a multiple regression. You just have to pull the function in Excel, pick the dependent variable and the independent variable. You have to be able to read the output from the regression. So let's read the output from the regression. First, R squared 73%. Good, bad. How do we know? What do we measure it against? What's a perfect regression's R squared would look like? 100%. So clearly it's not 100%. Don't expect 100% in any finance regression. 73% is good with an asterisk. And here's why. It's a small sample and I have 3 variables. So there is this problem, one outlier can take. Let's take a look at the output. That's called the intercept or the constant. So that's the base from which I'm going to build off. How do I read this minus 7.94 in interest rates? What is it telling me? In my sample, every 1% increase in interest rates lowers my PE ratio. So higher interest rates, so that's good. That's intuitively what we expected. Higher real growth translates into a much higher PE ratio. And higher risk translates into a lower PE ratio. Each of our intuitive expectations has come into play. The reason I emphasize that is don't expect that to always happen. The data is the data. It doesn't have to agree with your priors. And when it doesn't agree with your priors, guess what has to change? It's not the data, it's your priors. Something's wrong with your priors. So don't mess with the output saying that's not the sign I expected, so I'll take the minus and make it a plus. That doesn't work. You're saying, what do I do with this regression? I'm a portfolio manager. What do I do with this regression? If I took Turkey's interest rates, real growth in GDP and country risk from the previous page and plug them into this regression, you know what I'm going to get? I'm going to get a predicted PE ratio for Turkey given its risk, given its growth, and given interest rates. And I can do that for each of my countries. That's exactly what I did in this page. So for Argentina, for instance, the actual PE ratio is 14, but if I plug in the interest rates, growth, and country risk in Argentina, my predicted PE is 13.57. Given Argentina's risk, interest rates, and growth, and given how the market is pricing every other country here, I would expect Argentina to be trading at 13.57 times earnings. It's actually trading at 14 times earnings. What does that tell me? It's pretty close to fairly valued, but if you push me, it looks slightly overvalued, right? It's trading at 14. And you can compare. So rather than compare P ratios across countries, where I end up with Russia and Pakistan as my two countries that I invest in, here I'm comparing the P ratio for each country to the predicted P ratio for that country. At the start of 2022, if I put Russia's country risk and growth and interest rates, I might have been able to explain away the fact that they have low P ratios, or I might not. But this is a way of bringing in differences across countries. And rather than just waving your hands about the differences, actually bringing them into your forecast. Any questions on this? If your statistics is weak, it'll increasingly get tested during the next few sessions, because I will draw on things like basic statistics, correlations, regressions. I actually have my version of a statistics class. I pointed to this at the start. So there is actually a session on reading regressions. I would strongly suggest that you review that session, because if nothing else, you'll be able to take the output from regressions and say, what should I be focusing on? How do I know whether something is significant or not? Because we're going to be using this over and over again. Let's move forward. Over the last 15 years, one of the most common refrains I've heard from so-called market experts is stocks are overvalued. And the basis for that argument is very simple. They compute a P/E ratio for the market, the S&P 500. They compare to what the P/E ratio used to be in the past, and it becomes a slam dunk. In fact, let me back it up. At the start of 2022, the P/E ratio for the market is 23. Of course, P/E ratio for the market uses last year's earnings, so there are variants of it. There's a version called the Shiller P. It's attached by Robert Shiller, teaches at Yale, won the Nobel Prize, where he takes the price, the level of the index, and rather than just divide by last year's earnings, he divides by the average earnings over the last 10 years, kind of a normalized earnings. There's a version of P called CAP, which is takes the average earnings adjust for inflation. So all these are finessing the P, but using whatever measure P you want to use. You look at where we are at the start of 2022 and compare it to where we used to be going back in time. Clearly, we're trading at a much higher multiple of earnings now than ever before. It's a fact. I mean, I'm not even going to contest that. But what they then do is they take that and say, that must mean stocks are overvalued. What am I missing when I make that statement? Because I've heard the statement at least once every day on if you watch CNBC all day, which is not a good thing to do, but if you do, at least once every day, there will be an analyst who gets on and say, stocks are overvalued because the P/E ratio now is higher than it's been in the past. What's the problem there?
I mean, there's more money in the system.
Okay, but that's an explanation for why it's over. You're conceding the argument. Don't be so quick to concede. Is it in fact true that having a higher P/E ratio now means that stocks are overpriced? What is the alternative? If you don't buy stocks, let's say you agree with them, stocks are overvalued. Where are you going to put your money?
Bonds.
You're going to put it in bonds. Let's say you put it in T-bonds, right? 25 years ago, when the P/E ratio was 15, you put it in T-bonds, you made 5%. Today, you take your money out, you put in T-bonds, you make 2.5% or 2%. Everything is relative, right? Price earnings ratio of 24 looks high until I tell you the alternative is to put in T-bonds and make 2%. So about 4 years ago, I got sick and tired of this Shiller P argument coming from Shiller himself. And I said, let's do a simple graph where I can show you that stocks are cheap. So here's what I did. If the T-bond rate is 2%, can I compute a P/E ratio for a T-bond? What's a P/E ratio? I take the price, divide by earnings, right? The 2% rate becomes the earnings, $100 price. That's a P/E ratio for the T-bond of 50, right? So what I did was I actually did a graph of, so the purple line is the Shiller P. And you can see the basis. Shiller P has gone up. But take a look at the blue line. You know what the blue line is? That's the P for the T-bond. And I could actually make the argument that stocks are cheaper today than they were 10 years ago, 20 years ago, because relative to what you're paying for T-bonds, stocks look like a bargain. I'm not going to be stupid enough to go out and do something crazy on this basis. But my point is you can't just take a P/E ratio and draw these conclusions about markets because it's insanely lazy. So let's take a deeper look at P/E ratios today. And let's see if we can make a more conditioned statement that brings into effect what rates are today. So what I'm going to do actually is going to sound weird, but I'll tell you why I'm going to do it. The P/E ratio is price divided by earnings. Everybody uses it. But if you invert the PE ratio, it's called the earnings yield. It's earnings divided by price. You're saying, what do I gain by doing it? Well, the earnings to price ratio is actually a more robust ratio for the following reason. What happens to the PE ratio when earnings turns negative? It becomes not meaningful. The earnings to price ratio can still be used even if earnings are negative. So what I did was I graphed out, see this orange or whatever color that is, that's the earnings to price ratio for the S&P 500 going back to 1960. The blue line is the T-bond rate going back to 1960. If I just showed you those two lines and asked you to tell me whether the two move together, the answer is, yeah, of course. When one goes up, the other goes up. When T-bond rates are high, the earnings to price ratio is high. When T-bond rates come down, the earnings to price ratio comes down. You're saying, what's this third line? That's a difference between the T-bond rate, the 10-year T-bond rate, and the 3-month T-bill rate. What does it measure? If I take the 10-year bond rate and I subtract out the 3-month T-bill rate, what am I measuring with that number? I'm measuring the slope of your yield curve. You're saying, who cares? In fact, if you've been reading the Wall Street Journal for the last couple of weeks, this has become one of the big issues in the market. And here's why people care. When the T-bond rate is much higher than the T-bill rate, you got an upward sloping yield curve. When the T-bond rate is roughly equal to the T-bill rate, you got a flat yield curve. And if the T-bond rate actually drops below the T-bill rate, which has happened like 9 times in the last 87 years, you got a downward sloping yield curve. And right now, for the first time in like 5 years, the yield curve has gone downward sloping. The 10-year bond rate is actually falling below the 2-year rate. It's not below the 3-month rate yet, but the whole curve is starting to level. Why is that such a big deal? Why do markets freak out?
They tend to say that it's an indicator of a recession.
Yeah. And in fact, you can look at the time periods, 1974, 1981. In fact, if you go through it, the periods when the yield curve has gone negative have been usually recession periods. But what's the intuitive link that causes this downward sloping yield curve? Yeah.
That people are pricing in, that they have more confidence in the next 10 years than they do in the next 3 months.
That's actually, but think about why yield curves invert. It's usually not because the T-bond rate collapses, it's because the T-bill rate soars.
Yeah.
What causes T-bill rates to soar? It's central banks actually freaking out and hitting the brakes. This is a Fed effect you're capturing here. Historically, when yield curves have become downward sloping, it's usually because the central banks are starting to tighten things up because they're worried about inflation or something else in the economy. And historically, that's preceded a slowing of the US economy. So I can understand it's become a proxy for real growth. So the first thing I did was I did a correlation matrix. I told you I'm going to draw on a lot of statistics, so don't get freaked out. A correlation matrix just to see how these variables move together. Let's start with the slam dunk part. Earnings yields and T-bond rates move together an awful lot of the time. The correlation is 0.68. In other words, one goes up, the other goes up. Earnings yields and the slope of the yield curve work in opposite directions. In other words, if I have an upward sloping yield curve, and the bond rate is much higher than the bill rate, my earnings yield is much lower. Remember, you got to invert that. So I enjoy much higher PE ratios when I've got an upward sloping yield curve than when I have a flat and a downward sloping yield curve. Correlation matrices are a good place to start. Whenever you have 3 or 4 or 5 variables, are they related to each other? But I want to go further. I want to be able to make a prediction for the market. Is the market cheap or expensive? So again, I went back to my regression rule book. I said, let me run a regression of earnings to price ratios for the S&P 500. This is called the time series regression. Time series because I'm taking 60 years of data. The other type of regression you can run is called a cross-sectional regression, where I look at a bunch of companies and see why the PE ratios are different across companies. The time series regression. The R squared I got was 46%, not bad. I'm just using interest rates to explain earnings to price ratios. T-bond rates, very highly linked to every 1% increase in T-bond rates increases my earnings to price ratio about 0.55. But if you look at T-bond minus T-bill rates, the slope of the yield curve, that T statistic, you know what the cutoff for T statistics is for significance? You want it to be 1.7, 1.82. The higher the number, the more statistically significant. T-bonds are clearly significant. 7.10, no question, it's 99.99% chance. But the T statistic on the T-bond minus T-bill rate is now statistically insignificant. You're saying, what do you mean by now? Because I've been running this regression pretty much every year, going back to 1990. In 2008, when I ran this regression, the T statistic was closer to significance, 1.46. Since 2008, the link between the slope of the yield curve and what happens to markets has become much, much, much weaker. Something to keep in mind as you have people freaking out about the slope of the yield curve. What's happened since 2008 that's made the slope of the yield curve less predictive, you think? Think about the level of rates. Pre-2008, T-bond rates used to be 4 or 5%, right? When T-bond rates start to drop towards zero, how upward sloping can your yield curve get if your T-bond rate is 2%? In Japan, who cares about the yield curve? Your T-bond rate is close to 0%. In a strange and perhaps dangerous turn, the lower rates become, the less power central banks have to drive the economy. That's why the Japanese central bank is kind of helpless. They can't do a thing. The European central bank, same problem. US has a little more leeway, but not as much as it did 10 years ago, 20 years ago, 30 years ago. It's one of the, I think, the downsides of rates getting low is you lose that power for central banks to at least tweak the economy, which is a good thing to have. Any questions on PE ratios? So let's move to the second multiple, called PEG ratios. Let me give you a little bit of history. Until the 1970s, PE ratios were the dominant metric used by portfolio managers. And the rule was simple: buy low PE ratio stocks. You know what the exact year was? The guy called Peter Lynch got hired by Fidelity to run a new fund called the Fidelity Magellan Fund. It was the first growth mutual fund. Until then, every mutual fund was diversified, big mature companies. Peter Lynch was given this task of build a growth mutual fund. And initially, he looked at PE ratios and he discovered very quickly that he was running into a brick wall. Do you see why? If you pick stocks that trade at less than 15 times earnings or less than 12 times earnings, no growth company is ever going to make the mix, no matter how great the growth rate is. So I think it was in his very first book, he described what he did. He said he looked at the PE ratio, but he also looked at the growth rate. He said, if I have a high PE ratio and a high growth rate, I think the stock is cheap and I'm going to buy it. He actually didn't create PEG ratios, but you can see he laid the foundations for it, because if you take a high PE ratio, let's say it's 50, but your stock is growing at 100% a year, 50 divided by 100% gives you a 0.5 PEG ratio. It basically makes it a cheap stock. In contrast, if you have another company trading at 20 times earnings, but its growth rate is only 10%, its PEG ratio is 2. 0.5 is cheaper than 2. It allowed Peter Lynch to buy growth companies because the PE ratio, even though it was high, was compensated for by the growth rate. And that ratio is kind of hung around. There are a lot of tech analysts who still use PEG ratios. And to me, it's one of the most abysmally constructed multiples. I don't blame Peter Lynch for it. It's an extraordinarily dangerous multiple. And let me explain why. Remember how I computed the PE ratio for a firm using that dividend discount model? I went back to that equation, played around, and I came up with an equation for the PEG ratio. So in the two-stage dividend discount model, if a stock is correctly valued, the PEG ratio is determined by all the variables you see in the equation. Two are predictable. Higher risk companies have lower PEG ratios. Higher growth companies have higher PEG ratio. I'm sorry, and growth is going to be the unknown variable. The higher payout ratio companies that pay out more for a given growth rate have higher PEG ratios. But take a look at the equation. Growth hasn't disappeared. The reason I say that a lot of analysts who use PEG ratios think that it neutralizes growth. They say, I can compare companies with different growth rates. I've already brought it in the equation. And that's definitely not true. In fact, growth is everywhere. It's in the numerator, the denominator. The relationship has become incredibly messy. So here's what I'm going to do. I'm going to go back again to a simplistic example, and I'm going to derive a couple of conclusions about PEG ratios that I want you to keep in mind when you read equity research reports based on PEG ratios. Let me take the two easy variables first. Higher risk companies will have lower PEG ratios than lower risk companies. Why? Because if I have the same growth rate for two companies, one is low risk and one is high risk, the high risk company will always have a lower PEG ratio. Higher return on equity companies, companies that earn better returns on their projects will trade at higher PEG ratios than companies with lower returns on equity. But if you ask me what the link is between growth and PEG ratios, I'm going to throw up my hands and you're going to see why when I take an example and work it through. Will PEG ratios go down as growth rates go up? Initially, yes, but at some point in time, the relationship reverses. You get a U-shaped relationship, and that's messy when you're working with multiples. So rather than deal in abstraction, let me go back to that example that I did earlier. Remember, I had a company, high growth, 15% for the next 5 years, 1.5% thereafter. So take the same company, and rather than compute the PE ratio, I computed the PEG ratio for the company. So again, this equation just gives me a two-stage dividend discount model value. So if this stock were traded as that model suggests, the PEG ratio for this company should be 1.94. There goes another rule of thumb, because you know what the rule of thumb with PEG ratios usually is? If it's higher than 1, a company is expensive. If it's less than 1, it's cheap. This company trades at 1.94 times earnings and it'll be fairly priced. Let's see what happens though to this PEG ratio as I start changing things. So here's the first change I ran. I kept everything else constant and tried higher betas, lower betas. I said, what will happen to the PEG ratio as risk goes up? And here the answer was quite clear and decisive. Higher risk companies will trade at lower PEG ratios than lower risk companies, and there are no exceptions. I told you should keep this in mind as you read equity research reports. Last week, I was reading an equity research report on I don't know which tech company. It was probably NVIDIA. I was reading it. And the equity research analyst had computed the PEG ratio for NVIDIA. It's easy enough to do, right? PE ratio divided by growth rate. And he was comparing it to the PEG ratio for the S&P 500. And he found that the PEG ratio for NVIDIA was lower than the PEG ratio for the S&P 500. So far, no. And then he drew a conclusion. He said that means NVIDIA is cheap because its PEG ratio is low. What's the flaw in that final conclusion? NVIDIA has a lower PEG ratio than the S&P 500, true. But why can't I jump to the conclusion that means NVIDIA is cheap?
Can I answer?
Yeah, go ahead.
It's beta, NVIDIA's beta probably exceeds the beta of the S&P.
It's much riskier than the S&P. We don't even need to use beta terms, right? It's a tech company. Lots of things can change. It's riskier. So NVIDIA looks cheap, but it's not cheap. Remember what I said at the start of pricing? Most things that look cheap deserve to be cheap. Basically, NVIDIA is a good reason for having a low PEG ratio. So go online. You can find equity research reports you can browse through for free. Find one based on PEG ratios, and you're going to be running into this failure to control for risk over and over again. Here's the second thing I tried. I kept the PEG rate, the growth the same, and tried different returns on equity. And here again, the results were pretty clear, pretty straightforward. As I kept the growth fixed, as my return on equity went up, the PEG ratio went up. In other words, if I'm comparing two companies and I just look at PEG ratios and I don't control for returns on equity, guess what companies are going to keep looking cheap to me? Companies with low returns on equity are going to look cheap, and I'm going to think they're cheap because the PEG ratio is low, when in fact it's a difference in returns on equity. So the first two controls are easy. When you use PEG ratios, you need to control for risk, you need to control for return on equity. But here's the part that really threw me off. What I've done here is I've taken 4 different risk-free rates and different growth rates. I've computed the PEG ratio as growth rates go up. And with each one, something weird starts to happen, which is initially as my growth rates go up, the PEG ratio comes down, but there's a point where you get this tipping point where things start to turn. In other words, PEG ratios start to, and that is really messy when you're using a multiple. And here's why. Most of the time, what do analysts do? They control for the multiple subjectively. Higher growth companies have higher P ratios. Okay, that's fair enough. But with PEG ratios, you can't make that statement because of this weird relationship between growth and PEG ratios. So let's summarize what we've learned about PEG ratios. First, high-risk companies will have lower PEG ratios than low-risk companies. And I can't compare high risk to low risk. Second, companies that earn higher returns on equity will have higher PEG ratios than companies that earn lower returns on equity. But on growth, I'm going to give you a wishy-washy answer. If your growth rate is around average, you'll have a lower PEG ratio than if you're either extreme. So if you take a sector, let's say there are 50 companies, the companies with growth rates around the average will tend to have the lowest PEG ratios. The companies that are either extreme will look expensive because of the way PEG ratios are constructed. I don't think I've ever used a PEG ratio because I can't control for variables well, because I don't even know the direction of the relationship. That's why when you use PEG ratios, you got to be careful, because that growth component can do strange things to you. So we talked about PE ratios, we talked about PEG ratios. Let's finish one final equity multiple, price to book. Price to book is perhaps every value investor's favorite pricing metric. For the longest time, Berkshire Hathaway, Warren Buffett would give you the price of the stock and he'll tell you what the book value did during the year. So if you say, what is it that drives price to book? Again, the answer is pretty straightforward. Go back to a stable growth dividend discount model, divide both sides of the equation by the book value, and you end up with an equation for the price to book ratio. The price to book ratio is determined by 4 variables. 3 should be familiar: cost of equity, growth, and payout. Exactly the same 3 that you saw with PE ratio. But a 4th variable pops up, which is the return on equity. High return on equity companies will have high price to book ratios. Low return on equity companies will have low price to book ratios. So here's the equation for price to book. It's return on equity times payout ratio divided by cost of equity minus growth. But remember that growth can be written as a function of the payout ratio. Then growth is equal to retention ratio times return on equity. If I plug that back in, the price to book ratio actually simplifies into return on equity minus growth in the numerator and cost of equity minus growth in the denominator. You know what that means, right? If your return equity is roughly equal to your cost of equity, your price to book ratio should be roughly 1. If your return equity is much higher than your cost of equity, your price to book ratio should be higher than 1. And if your return equity is consistently lower than your cost of equity, your price to book ratio should be less than 1. And it's not last year's return equity, it's expected return equity. It's that magic ingredient that explains why companies trade at low price to book ratios. Our price to book ratio is less than 1, but they're not cheap. They deserve to trade at that multiple because their returns on equity are so low. Now, there is an analog. That's an equity multiple. There's an analog if you think about enterprise value. Instead of using market cap in the numerator, which is what I do for price to book, what if I used enterprise value, equity plus debt minus cash? And in the denominator, instead of using book value of equity, I use book value of equity plus book value of debt minus cash. It's invested capital. You know what drives that multiple? It's return on capital minus growth divided by cost of capital. You see how they're twinned together. Price to book ratio, it's return on equity versus cost of equity. Enterprise value to invested capital, it's return on capital versus cost of capital. If you take every equation that I have in the pricing notes and you write it as a separate equation, you're going to drive yourself crazy. After a while, you got to recognize it's the same equation. All I'm doing is changing equity to firm. So it's the same equation playing out over and over again. EV to EBITDA, 2 more multiples, and we'll put this to rest. Most widely used multiple now in terms of growth since in the last 40 years. And it's a basis for all this rule, absolute rules. 6 times EBITDA is cheap, 8 times EBITDA is cheap. So here's what I want you to think about. Yeah. So wherever you go to work, let's assume you go to work for a company that's an acquirer. You know what you're going to get is phone calls from people claiming to have found a great bargain for you. And the most common way in which this bargain is going to be presented is, this company is cheap, it's trading at 5 times EBITDA or 4 times EBITDA. So what I want you to think about is the variables as I list them and what you would like in a perfect company. So here's what I did. I went back to a firm valuation model, free cash flow of the firm next year divided by cost of capital minus the growth rate. I rewrote the free cash flow of the firm in terms of EBITDA. Trust me, I'm not changing the free cash flow equation, but I'm writing it in terms of EBITDA. EBITDA times 1 minus T plus depreciation's tax benefit minus CapEx minus change in working capital. Usually we write it as EBIT times 1 minus T plus depreciation. It's basically the same equation written in terms of EBITDA. Why do I want to do that? It makes my algebra a little easier. If I divide both sides of this equation by EBITDA, I now have the variables that determine EV to EBITDA. So as I go through these, think about the question you're going to ask me when I tell you that I found a great bargain for you. First variable that drives EV to EBITDA is the corporate tax rate. The higher the tax rate for a company, the lower the EV to EBITDA will be for that company. Now, when we did PE ratio, how come we never asked about tax rates? Why with PE ratios did we completely ignore corporate tax rate? With EV to EBITDA, I seem to be asking questions about tax rates. In PE ratio, what's in the denominator? Net income. Net income, which is already after taxes, right? So if you have a high tax rate, your net income already reflects it. The problem with EBITDA is it's a pre-tax number. So I need to know whether your tax rate is 2%, 20%, or 80%. Makes a huge difference. What's your corporate tax rate? If you take the next three variables, depreciation, CapEx, and change in working capital, and you consolidate them, CapEx minus depreciation plus change in working capital, that's reinvestment. So the second question I'm going to ask you, if you tell me a stock is cheap, is in addition to your tax rate, I'm going to ask you, how much did you reinvest last year? Maybe you're in this capital intensive business. We're going to invest huge amounts to get that growth rate. You should trade at a much lower EV to EBITDA. So tax rates matter, reinvestment matters. Go to the denominator, cost of capital. You're comparing two companies. One is a Russian company, the other is a German company. They're both steel companies. They have exactly the same tax rate and the exact same reinvestment. I would expect the Russian company to trade at a lower multiple of EBITDA because its cost to capital is going to be much higher. Country risk plays a role. Cost of capital matters. And finally, growth matters. Higher growth companies holding all else constant should have higher EV to EBITDAs. So construct the perfect cheap company on an EV to EBITDA basis. I call you and say, this company is cheap, trades at 5 times EBITDA. First question you want to ask me is, what's your tax rate? What would you like to hear? Low tax rate or high tax rate? Preferably no taxes at all. That'd be even nicer, but a really low tax rate. Second question you're going to ask me is, how much did you reinvest last year? You'd love to hear me say, oh, we don't reinvest anymore. We have lots of excess capacity. We're an infrastructure company. We reinvested before. And ask you, what's your cost of capital? Where are you incorporated? You'd love to hear that I'm incorporated in Germany or the US, and I do all of my business in the EU or the US. Not that I'm an Indonesian company, a Brazilian company, or a Russian company. And when you ask me about growth, you'd like me to tell you. So basically, you want a company with low EV to EBITDA, low taxes, low reinvestment, high growth, and low country risk. Again, you might say, what chance do I have finding something like this? No harm looking. You have what 46,000 companies look through. Who knows what kind of mistakes markets make? So with EV to EBITDA, I did what I did with PE and PEG ratios. I took an example, a made up example of a company with a 36% tax rate, CapEx of 30% of EBITDA, depreciation 20% of EBITDA, and a cost of capital of 10%. Let's assume no working capital. If you ask me, what is a fair EV to EBITDA for this company? If I plug the numbers in, tax rate, depreciation, CapEx, no working capital, my EV to EBITDA for this company is 8.24. At 8.24 times EBITDA, this company would be fairly valued. But the interesting thing again is changing the variables. If I change the tax rate from 40% down to 0%, this very same company is going to trade at 14 times EBITDA. You think, when would I ever run into companies with tax rates that different? Let's say you end up in Europe. As the analyst who covers European companies, you've got an Irish company in your group and a German company in your group, you should expect the Irish company to trade at a higher multiple of EBITDA. Same thing with reinvestment. If I hold all its constant and increase my net capex to get the same growth, the more net capex I have, the lower my EV to EBITDA. Or if you want to frame it differently, the higher the return on capital I can make on my projects, the higher the multiple is going to be because I need to reinvest. Now, again, think of this as questions you can ask now. It's not about mechanics or equations. It's about asking the right questions. One final multiple, and then we'll put this in the analytical part to rest. Last multiple I'm going to look at is EV to sales. Big, widely used, especially in retailing. I list out the variables that drive EV to sales because I can get them by going back to a discounted cash flow model and plugging in the numbers. The EV to sales multiple is a function of 4 variables. I'll list out the first 3 because they'll show up in every EV multiple. It's a function of your cost of capital. Higher cost of capital companies trade at lower multiples of revenues. It's a function of your growth rate. Higher growth increases your EV to sales. It's a function of your reinvestment rate. Because if you can get that same growth rate with a lower reinvestment rate, you should trade at a higher multiple. But here's what I call the companion variable, the big one. It's your after-tax operating margin. Higher margin companies, and this is something we saw at the start of the class, will trade at higher multiples of revenues. So I'm going to use that insight to answer a question that many of you might have seen in your marketing class. You know how marketing people like to talk about brand name? Often, I don't think they have any idea what they're talking about, but it sounds like something good. But at the start of this class, I told you what the power of a brand name is. It's the power to charge a higher price for exactly the same product. And in the last 15 years, accountants have wanted to put brand name value on the balance sheet. So let's embark on this mission of how can we use discounted cash flow valuation, or what we've learned about EV to sales, to value a brand name. Remember, EV to sales is driven by after-tax operating margin. So good brand name companies will have higher margins, trade at higher multiples of revenues. Now, one simplistic way of valuing brand name is to compare the EV to sales ratio for your company to the EV to sales ratio for the sector. And take that difference, say that's because of brand name. That's how Interbrand, which is one of the leading brand name companies in the world, estimates brand name. It's very back of the envelope, if you ask me, but they just take the difference in multiples of revenues. But if you want to really narrow down on what the value of a brand name is, here's what you need to do. Value a company with the brand name, with a high margin, come up with an EV to sales. Then do a second cut at the same company and ask, what will happen to those margins if it loses its brand name? It becomes a generic product. Margins are going to be lower. Your EV to sales are going to be lower. Take the difference. You got to value brand name. Sounds abstract, right? So let me try this. It's about probably 20 years ago. It's a long time ago. One of the people who went through this class ended up at Coca-Cola, rose up the ranks. So he called me and he said, can you come in and talk to our top management group about the value of our brand name? It's a big deal at Coca-Cola. So I said, sure. So I showed up and I did an intrinsic valuation of Coca-Cola. So basically I took that, they had high margins, high return on capital, high growth rates. Bottom line was I valued Coca-Cola at about $80 billion. Then very close to market price. So I finished the valuation. The head marketing honcho, who was sitting in the first row, puts up his hand. And he says, you forgot something very important. So what did I forget? A beverage or geography? I must have missed something big. So what did I forget? He said, you forgot that Coca-Cola has one of the most valuable brand names in the world. I said, what exactly do you want me to do? He said, you should be adding at least a 20% premium to that 80 billion. I said, why? He said, because that's what we do at Coca-Cola, is when we buy brand name companies in other countries, we value the company, then we add 20%. I said, just because you do stupid things doesn't mean I have to do stupid things too. He said, don't you think our brand name has value? I said, it's probably the only thing in this building that has value. It's not your syrup. It's not the taste. It's not the damn red can. He said, why aren't you attaching a premium? Because it's already in there. You see where it's at? That margin of 15 point, you think that's because of taste? Let that go. Remember that new Coke, old Coke crap that you pulled off about 30, 40 years ago, thinking taste actually mattered? You have a high margin because of your brand name. That high margin drives your high return on capital. Your high return on capital gives you a high growth rate. Your high growth rate gives you an $80 billion value. You know what he said? I don't believe you. This is what happens when you argue with marketing people. But I came prepared. And I was luckier. I said, let's play a little game. Let's suppose tomorrow we all woke up with selective amnesia. And the only thing we didn't recognize was the red can or the word Coca-Cola. This is every marketing person's nightmare. Let's make it come true. I said, what would happen to your margins? And this is where I got lucky. I found a Canadian company called Cott. The reason you've probably never heard of the company is they make generic soda. So you walk into a grocery store and buy the store brand. Card often makes them and lets every grocery store put their own name on it. Their margins are 5.28%. So this is not Coca-Cola versus Card. It's Coca-Cola with Coca-Cola's margins and Coca-Cola with Card's margins. And if Coca-Cola loses its brand name, my assumption is your margins are going to drop to Card's margins, which is going to translate into a lower return on capital, lower growth rate. And if you trace it all the way down, without your brand name, you're worth 15.4 billion. You want me to add a brand name premium? I just did. 80% of your value comes from the brand name. If you don't think that's enough, tell me why, but don't give me this add 20% to that number, because that makes no sense. It's easy at Coca-Cola because the only competitive advantage Coca-Cola has is brand name. If I try to do this at Apple, I'm going to run into a problem. You know what that problem is going to be? With Apple, there's a brand name effect, and there's an operating system effect, and there's a styling effect. If you have 4 competitive advantages, it becomes much more difficult to slice and dice. And that's what terrifies me with accountants trying to do this, is they're trying to slice and dice. I've told them up front, it's impossible to do. You cannot separate brand name from all of that other stuff. What you're going to be able to give me is the collective value. The case of Coca-Cola, that collective value happens to be brand name. So take a look at this page. Basically, this is just with taking so 4 different equity multiples. And basically, it goes back to the root and says, this is the base equation. All I'm doing is algebra. And with the algebra, I can tell you no matter which multiple you pick, what the variables are that you should control for that multiple. It's a great tool to have in your toolkit, because analysts are going to keep inventing new multiples. EV to subscriber. What should I be asking? Go back to basics. You can always come up with the right questions to ask. You define, describe, analyze. Let's at least get started in application. To apply pricing, you need to find comparables. And if you believe Wall Street, what are comparables? They're always companies in the same sector. Have you noticed this? Steel companies to steel companies, software to software. It's a lazy way of saying, if I pick other software companies, they must have similar risk and similar cash flows and similar growth. But that's increasingly difficult to defend, right? Microsoft is a software company. Adobe is a software company. Palantir is a software company. Very different companies. So the first thing I'm going to push back on is maybe there's a better way of defining comparables that allows me to find companies with similar cash flows, similar growth, and similar risk. The second is, even if I can do that, there will still be differences between my company and those companies. And I have to figure out ways to control for those differences that go past storytelling. So I'm going to at least get started on this process, because if you've done your DCF, you got my feedback, you put that behind you, there's a second half of your project. It's really not a half because it's much less work than your DCF. I want to ask you to price your company. And one of the things you will need to price your company is to come up with comparable companies. Now, I'll give you the 2 routes you could take. You could try to find companies just like yours, the same market, same size. In other words, you define comparable narrowly, in which case you're going to get relatively few firms. Or you can define comparable broadly. You can say all steel companies listed anywhere in the world. And you're going to have to make this choice. Do I want to pick companies just like mine and end up with a small sample, or be much more liberal about what I call similar and come up with a larger sample? Remember what I define pricing as? It's a statistical exercise. And in statistics, given a choice between a small sample of like companies and a much larger sample of companies that are not like mine, statistically, I am biased towards the latter over the former. Doesn't mean I will never use it. If I find companies just like mine and I can get to 25 or 30 companies, I'm okay. But if I can find only 4 or 5, I'm better off going with the larger sample. Keep that in mind when you go looking for comparable companies for your company. And then once you got those comparable companies, you'll need to control for differences. And I'll give you the 4 broad ways you can control for differences. One is if you can find a company just like yours, you can just do a comparison of. So if I know quite a few of you are doing Uber, right? If I ask you to price Uber, what's the most logical company you're going to price it against? You're going to price it against Lyft. If I ask you to price Lyft, you're going to price it against Uber. It's a very dangerous game because if two companies that go back and forth, you're saying, what about DD? DD's gone off. I don't even know where to put DD right now. It's in a strange place with the Chinese government. But if it gets listed, you could have 3 companies in the sample. So if I define Uber narrowly as a ride-sharing company, my sample size is small. If I define it more broadly as a transportation company, my sample size gets much bigger. But if I'm doing direct comparisons, it's really comparing one company to the other. It's really, just looking for differences, trying to control for them. Second is what most equity research analysts do. They tell a story. And here's how it will work. Your company has a PE ratio of 27. The sector average is 23. But you say, but that's okay. Why? Because this company has higher growth. It's kind of a fuzzy conclusion because it has to have a higher PE, but should it have 27? That's kind of left untouched. The third is to try to bring into the multiple what you think are the differences across companies. That's what PEG ratios originally were created. Different growth rates, let me bring them in. Let's say you're doing social media companies and you're worried about the number of users. You know what you could do? You could do enterprise value divided by the number of users if you think that's what's driving. But what I'm going to try to push you into is when you have lots of companies and big differences, it becomes very difficult to do this eyeballing subjective comparison. I'm not suggesting you replace yourself with statistics, but statistics is in fact, if I were teaching a statistics class, which I don't plan to, I'd make it entirely around pricing because this is the kind of data that statistics was designed for. Data which is contradictory, pulling you in lots of different directions. It makes sense. So next session, when we start, here's what I'm going to do. I'm going to play the role of a really bad equity research analyst. I'm going to give you really bad advice. And then I want you to push back and say of how I could control for the things I'm missing. What am I missing and how you'd bring it in. It's a great exercise in becoming a better pricer. And many of you are going to end up pricing things, not valuing things. And this is something you need to work on. So we'll see you on Wednesday.